What are multi-state tax rules for businesses? Imagine running a business that sells products online or has offices in several states. You might wonder how taxes work when you do business across state lines. Well, that's where multi-state tax rules come into play. These rules help determine what taxes you owe in each state where you operate or sell. When a business has a connection to a state, called Nexus, it triggers tax obligations. Nexus can be established through physical presence like offices, warehouses, or employees. It can also be economic, meaning if your sales in a state reach a certain amount, you might owe taxes there. Since the Supreme Court decision in the year 2018 in the case of South Dakota versus Wayfair, Inc., states can requiring online sellers to collect sales tax even without physical presence if they meet specific sales or transaction thresholds. Businesses might owe different taxes depending on the state. These include corporate income tax, gross receipts tax, sales tax, and payroll tax. Each state sets its own rates and rules. For example, Texas does not have a corporate income tax but charges a gross receipts tax. California, on the other hand, has higher corporate income tax rates. When a business operates in multiple states, it must figure out how much income to assign to each state. This is called apportionment. The goal is to divide income fairly based on where the business's sales, property, and payroll are located. States use formulas to do this, often considering the percentage of sales made in each state. To help with this process, there is a model law called the Uniform Division of Income for Tax Purposes Act. It guides states on how to fairly split income among different jurisdictions, preventing double taxation. States also have rules to protect businesses from unfair taxes. The U.S. Constitution's Commerce Clause limits states from taxing in a way that burdens interstate commerce too much. States need a proper nexus, fair apportionment, and must avoid discrimination between in-state and out-of-state businesses. Because each state has its own rules and rates, businesses need to stay organized. They must track where they have nexus, understand each state's laws, and file tax returns on time. Not doing so can lead to penalties or paying more than necessary. For Asian American business owners expanding beyond one state or selling online across state lines, understanding these multi-state rules is key. Getting help from tax professionals familiar with multi-state issues can make sure you stay compliant and pay only what you owe. Practical steps include monitoring sales thresholds, keeping clear records of property and payroll locations, and consulting experts who know these rules well.